Welcome to the deep dive. Today we're looking at Luxembourg. It's the world's biggest hub for cross-border investment funds, right?
Absolutely. Trillions managed there. And a lot of that success, it really comes down to one remarkably flexible tool,
hmm
this specialized investment fund, the SICAF.
The SICAF, exactly. It seems to be everywhere once you start looking.
It really is. Think of it almost like the Swiss Army knife for European fund structuring. Our sources point out its power comes from this balance it strikes.
What kind of balance?
Well, it manages to combine serious regulatory oversight, the kind institutions demand, with a huge amount of flexibility in how you set it up. Plus, and this is key, it's very tax efficient. It's engineered for global use.
And that engineering, that mix, is why it's the go-to for the big players, isn't it? Private equity, pension funds, family offices.
Precisely. The sophisticated end of the market. So our mission today is really to unpack this. We're going to dive into the laws behind it, the 2007 SF Law, the 2013 AIFM Law, and give you the full picture, the architecture, the rules, why it has such an edge.
Okay, let's start with the basics. What exactly is a SIF, and who was it built for?
Right. So the SIF was created really to cater to the boom in alternative investments, after the early 2000s. It's a regulated fund, definitely. But, and this is the crucial point, it's only for sophisticated investors, what Luxembourg law calls well-informed investors.
That restricted access seems fundamental. By limiting who can invest, you change the whole regulatory game, don't you? It allows for more freedom later on, like in what the fund can actually invest in.
Exactly. Keeping the general public out lowers certain types of regulatory burden, which unlocks that wider investment universe we'll talk about. But freedom isn't the whole story. There are still significant safeguards.
Okay.
Most SIFs will also qualify as an alternative investment fund, an AIF. So you get this dual regulation. There's the basic SIF law that provides the structural flexibility, and then you've got the AIFM law layered on top.
Right, the AIFM law. That's managed by the fund manager, the alternative investment fund manager. That layer brings in the heavy-duty institutional standards, correct?
Absolutely. The AIFM law is all about investor protection at an institutional level. It imposes strict rules for risk management, detailed reporting, controls on leverage, how valuations are done. It's the cost of entry for institutional credibility, really.
But the reward for taking on that extra layer of regulation is pretty significant, isn't it? I'm thinking of the AIFM passport.
Yes. That's probably the single biggest operational win. If your SIF is managed by an AIFM that's authorized anywhere in the EU, it gets this passport.
And the passport lets you.
It gives the manager the legal right to market the fund to eligible investors across all EU member states. No need for 27 different local approvals. It's a massive advantage for distribution. A shortcut, essentially.
Okay, a huge shortcut to the whole EU market. So if that's the prize, let's nail down who you can actually market to, this well-informed investor definition. It sounds strict. Who makes the cut?
It is strict, and that's intentional. It ensures the risks are shouldered by those equipped to handle them. There are basically three ways to qualify. The first two are pretty clear-cut. You have your institutional investors, pension funds, insurance companies, sovereign wealth funds, big family offices, that kind of entity.
The usual suspects.
Right. And then professional investors, using the legal definition from MiFID II, standard financial sector stuff.
Okay, What about that third group? Maybe high net worth individuals who aren't strictly institutional.
Yes, that's the interesting one. These are classified as other investors. They need to sign something confirming they understand they fit this category and meet one of two financial tests. Either they're advised by a regulated financial institution, like a private bank that certifies they're competent enough to understand the risks involved, or they commit to investing a minimum amount.
Which is?
You are under 25,000. That minimum ticket size acts as a barrier to entry. It ensures the investor has, substantial skin in the game and likely a certain level of financial understanding.
Yeah, 125K certainly sets a bar.
Yeah.
Okay, so we know who can invest. Now, the structure itself, this is where that Swiss Army knife idea comes back, right? The multi-form flexibility.
This is where the design really shines. The sponsor, the person setting up the fund, has enormous freedom to pick a legal form that fits their strategy like a glove. You can tailor it for anything, really. Short-term liquid strategies or decade-long infrastructure plays.
And the main split seems to be between a contractual form and corporate forms. Let's start with the contractual one, the FCP.
Right. The FCP, Fonds Command de Placement. Key thing here. It's basically a pool of assets co-owned by the investors. It doesn't have its own separate legal identity.
So it can't act on its own.
Exactly. It must be managed by a Luxembourg management company. The assets are held by the custodian for the investors. It's often chosen for open-ended funds, maybe bond funds or some hedge funds, where administrative simplicity is a big plus.
But if you're dealing with things like private equity or real estate, things that aren't easily bought and sold, sponsors tend to go for the corporate options, the SICAV and CSSF.
That's generally the case. The SICAV Société d'Investissement à Capital Variable is open-ended. Its capital goes up and down with investor subscriptions and redemptions. The SICAF Société d'Investissement à Capital Fixe has fixed capital. That's your typical choice for private equity, private debt, real assets. Strategies where the money is locked in for the long haul.
And even within those corporate forms, there's more choice, right? Different company types.
Yes, you can structure your SICAF or SICAF as several different Luxembourg company types. There's the SA, which is like a public limited company, the SARL, a private limited liability company. There's even a cooperative form, the COUP SA, and importantly for alternatives, the SCA, the partnership limited by shares.
Why is the SEA important, and how does choosing between, say, an SA and an SEA impact things?
It has huge implications, particularly for tax. An SA is a standard corporate structure, easily recognized, but an SCA is often preferred, especially in private equity, because it can be treated as tax transparent for the limited partners, meaning the income or gains flow through to the investors and are taxed in their hands according to their own tax status and location. You avoid a layer of tax at the fund level itself. The choice between SA and SCA often comes down entirely to what works best for the tax situation of the target investors.
Wow. Okay, so the legal wrapper isn't just window dressing. It directly impacts investor returns globally.
Absolutely. But perhaps the biggest structural advantage, especially for managers running multiple strategies or for large family offices, is the umbrella structure.
The umbrella structure, this is about compartments, right? Tell us why that's such a big deal.
It is. An umbrella SIF lets a manager create multiple sub-funds or compartments, all under one single SIF license from the regulator. Crucially, each compartment has legally segregated assets and liabilities.
Segregated how?
If one compartment, let's say, your European distressed debt fund runs into serious trouble, its creditors cannot touch the assets of your other compartments, like your venture capital fund or your real estate fund, housed under the same umbrella. They are legally ring-fenced from each other.
That's huge for risk management. And efficient, too, presumably. One license, multiple strategies.
Massively efficient. It simplifies the regulatory overhead significantly as you scale. Now, all this flexibility needs credibility. That comes from the regulator, the CSSF, the Commission de Surveillance du Secteur Financier.
Their approval is non-negotiable, right? That CSSF stamp is what gives institutions the confidence to invest, what's involved in getting authorized.
It's a thorough process.
Yeah.
You have to submit a big package, the draft prospectus detailing the strategy, the fund's constitutional documents, all the agreements with service providers, and importantly, detailed information on the people proposed for the board of directors.
You know, the CSSF reviews all that.
Yes. They need to be satisfied that the fund is set up properly, has the right governance, the right service providers, and understands its compliance duties before they grant the authorization, the official visa.
The sources mentioned it typically takes about 8 to 10 weeks. That sounds pretty quick for a regulated fund. Are there common sticking points? Things that slow it down?
That timeline is generally achievable if the application is high quality and complete from the start. Often, delays can center around the board members. The CSSF needs to approve each director based on their professional background, their experience, particularly with the asset classes the fund will invest in.
And there's an expectation for local directors, too, based in Luxembourg.
Yes, that's increasingly important. It's about substance. The CSSF wants to see that the fund isn't just a brass plate, that there's genuine management oversight happening in Luxembourg. Having experienced local directors on the board helps demonstrate that.
Okay, so strong board oversight with local presence, that's the governance core. But the day-to-day running relies on specific service providers, mandatory ones.
Absolutely essential. You need at least 3 key regulated partners.
Yep.
First, the central administration agent. They're the engine room, calculating the net asset value, NAV, handling fund accounting, preparing financial reports, managing the shareholder register.
Got it. Who's next?
Second, the custodian or depositary bank. Hugely important. They're responsible for safekeeping the fund's assets. But under the AIFM law, their role is much bigger. They also have crucial oversight duties.
Oversight like what? Checking the fund manager.
Yes. They monitor the fund's cash flows, make sure assets are where they should be, and verify that the fund is complying with its investment restrictions laid out in the prospectus. They act as a sort of independent watchdog. And third, you obviously need an independent auditor to sign off on the annual accounts.
Central, admin, depositary, auditor, the operational triangle. And what about the AIFM role itself? Can the SIF just manage its own affairs?
It can, yes, but only if it's structured as a corporate fund, a SICAF or SICAF. It can apply to be an internal AIFM.
And if it does that?
Then the fund entity itself performs the portfolio management and risk management functions internally. The big advantage there is that the fund itself holds the AIFM passport for EU marketing, rather than needing to appoint and rely on an external management company to provide the passport.
Right, okay. Internal versus external AIFM is another key structural choice then. Let's shift gears to what gets everyone excited. What can these SIFs actually invest in? We said it's flexible. How flexible?
It's about as flexible as you can get within a regulated EU structure. The sources confirm it's an unrestricted universe of assets. Seriously. Think private equity, venture capital, real estate, infrastructure, standard alternatives.
Okay.
But also loans, direct lending, distressed debt, non-performing loans, or NPLs, hedge fund strategies, listed securities, derivatives, even things like digital assets or intellectual property rights. It's incredibly broad.
So you could genuinely have a single SIF, maybe with different compartments, holding, say, shares in a tech startup, bonds from an emerging market, and a piece of commercial real estate, all regulated.
Absolutely. That's exactly the point. There are no rules saying you must invest in X or you cannot invest in Y. However, there is one major constraint. Risk diversification.
Ah, the diversification rule. That's the main regulatory limit on the portfolio itself.
Yeah.
How does it work?
The basic rule is a SIF generally cannot invest more than 30% of its assets or its capital commitments into securities of the same kind issued by the same single entity.
30% per issuer.
Correct. And that 30% limit also applies to short selling exposure. You can't have more than 30% negative exposure to a single issuer either. It's designed to stop the fund putting all its eggs in one basket, ensuring a baseline level of diversification.
Makes sense. A prudent limit. Okay, let's get to the final piece, which is often the headline grabber, the tax treatment. How does the SIF achieve this reputation for being so tax efficient?
It's mainly through exemptions. A SIF is simply exempt from the main Luxembourg corporate taxes. No corporate income tax, no municipal business tax, and crucially, no net wealth tax.
Wiped clean off the slate then. So what does it pay? There must be something.
There is, but it's minimal. It pays an annual subscription tax, the taxe d'abonnement, and the rate is tiny, just 0.01% of the fund's net asset value.
0.01%?
Yeah.
Per year?
Per year, yes. Calculated and paid quarterly based on the NAV at the end of each quarter. I mean, 0.01%, it's often less than some administrative fees. It really is a near zero tax burden at the fund level itself.
That's remarkably low compared to standard corporate tax rates anywhere.
Right.
What about the investors, especially those outside Luxembourg? How does it affect their returns?
For non-resident investors, it's generally very favorable. Luxembourg doesn't impose any withholding tax on dividends or other distributions paid out by the SAF. And if a non-resident investor sells their shares or units in the SAF at a profit, there's no Luxembourg capital gains tax for them to worry about.
So the efficiency passes through, maximizing what goes back to the investor.
Largely, yes. Now, there's one really important caveat we touched on earlier regarding structure. It's about double tax treaties.
Right. If a SIF invests internationally, say buying assets in Germany or France, it needs to avoid being taxed twice, once there and once potentially on the way out. Luxembourg has lots of tax treaties to prevent that, but can all SIFs use them?
No, and this is critical. Access to Luxembourg's network of double tax treaties is only available if the SIF is set up as a corporate entity, a SICAV or a SICAF.
Not the FCP.
Not the FCP. Because the FCP lacks its own legal personality, it generally can't claim treaty benefits in its own right. So, if your investment strategy involves cross-border assets where treaty protection against foreign withholding taxes is important, you must use a corporate SIF structure.
That is a fundamental dividing line then. It dictates the structure right from the start if you plan to invest globally.
Absolutely. So pulling it all together, you can see why the SIF is so central to Luxembourg's success. You've got that huge asset flexibility, the regulated status which institutions need, the potential for EU-wide marketing via the passport, and this incredibly efficient tax regime with just the 0.01% subscription tax. It's a very strategic package.
So thinking about this from the perspective of you, the listener, maybe you're a fund manager, maybe an institutional allocator, we just drew a really sharp line between the FCP, the contractual form, and the corporate SICAF forms. The FCP might look simpler, maybe a bit cheaper to set up initially. But if your fund needs to invest across borders and rely on Luxembourg's tax treaties to make sure returns aren't eroded by foreign taxes, well, then you have to go down the corporate route.
That choice has to be made right at the beginning.
Yeah.
It forces you to weigh up sort of administrative ease versus fundamental tax access for global investing.
Exactly. It's a trade-off between operational simplicity and strategic necessity. How do you balance those when designing a fund vehicle intended for global capital? That's the kind of sophisticated structuring challenge Luxembourg excels at addressing, something to really consider as you think about setting up or investing in these kinds of funds.